Good afternoon, Market Chameleons, and everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show with this man, Market Chameleon midday market show. First time ever we're doing a midday show. We had something that had happened in the morning, so we put it off to this afternoon. Thanks for joining us, everyone. How you doing, D? You're on mute, buddy.
There you go. I'm good. How are you, Will?
Great.
Before we get started, I just want to really quickly read over the disclaimer. Everyone keep in mind that Market Chameleon, Will and I, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen real quick. And if you guys are joining us for the first time and you have any questions, you can put those questions on the live chat on YouTube. Will's watching, he'll read it back to me. If you want to come on a show and ask your question live, direct, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Everybody will be able to hear you and you could ask your question directly. So those are two ways to ask questions. And while we queue up, while we're waiting for any questions to queue up, what I'll do is continue on the discussion from yesterday. I didn't get a chance to talk about a new feature, the dividend discount model that we added. And I'll start out with that, showing examples of that model in a stock. I'm going to pick a stock to use it on. And if you do get questions, let me know. I'll stop and try to answer those questions.
Perfect.
So I'm going to use, I think, Goldman Sachs as an example, and I'll explain why I'm using Goldman Sachs. So before I go to the dividend discount model, let me just recap. Why do we use pricing models? And when we talk about financial securities like options or stock, all right, we could observe the price. So here's the price of an option. I'm on the options chain, and I could observe all these different prices. For calls, this particular call has this price. Then this particular call has a different price. So when we look at the prices are trying to reflect a future expectation of the market, right? So the market is signaling something, and it's a future expectation of the value of the security or even the stock price. It's telling us something, and to extract it from the price, we need some kind of a model, right? To extract what is this price implying. So, look, for example, in an option, if I take this option, plug in all these other parameters into an option pricing model, what I could do is work backwards from the price and figure out the implied volatility, right? So based on this price, here's the implied volatility, and the market basically is forecasting that based on that price, that the volatility of the stock between now and expiration will be around this value. So now, based on that, I could then determine, well, I think that this volatility forecast is too high, then the option's overpriced, or I think it's too low, the option's underpriced, but then it helps me make that determination by working backwards from the price and figuring out what is the market's expectations. And you could work the other way and say, well, I'm going to take the model and I'm going to plug in my assumption, my volatility assumption, and we did, I think we did it here. I'm going to put in a volatility assumption, and let's just say there, let me see if I could, let's just say Goldman Sachs in the last 52 weeks traded at a 29.8 volatility. So I'm going to plug in that assumption into here, 29.8. I'm going to put that in a model, and then I'm going to generate what I think the price value of that option would be based on that assumption. So that's what I just did. So here are the theoretical values based on a 29.8 volatility. And then I could compare it to the market price to determine, oh, well, the market's got it much lower, so I think it's worth this much, and it's undervalued. So it could help you go both ways, right? To use the model to generate a theoretical value, or use the market price to go backwards and see, well, what are the market's expectations? So, and that will help guide your trading decision. So that's the same idea between, with options. You could do different pricing models using stocks, right? So when I'm looking at Goldman Sachs, I just see a price. So I can, I know it's market cap, this and this P ratio, but I don't know just by looking at it what could be the future expectations. So then you could create different types of model. One of them is the discount cash flow model, where you estimate the future cash flows and then take the present value and then compare it to the stock. And some stocks, not every stock you can use that model, the discount cash flow model, because of the nature of their business. So I picked Goldman Sachs because they are a bank, and banks are harder to reliably, estimate their free cash flow, just because of the nature of being a bank and the way they mark their earnings, or how they book their earnings, and they have all kinds of different risks on the book. Insurance company, the same thing. So not every stock you could even use it, right? Just like the Black-Scholes, you cannot use the Black-Scholes for events or other types of scenarios. So a different approach is a dividend discount model. So I'll show you guys what I mean. We added it here to fair value. And what the dividend discount model says is, okay, I can't project their free cash flow. I can't, even project their earnings, and, they got all this stuff on the book, but I can observe their dividend payments, right? And I could try to forecast what I think their forward dividend payments will be like. And then I have to give it a terminal value. So the concept is, like, think of it this way. And there's a couple things you'll need for this model. One is your required rate of return. And this is unique to you. There are, if you look at the, usually the models, they do what it's called like a weighted average cost of capital. It's a complex formula, and you do have to have assumptions in there anyway. So you're going to put assumptions into that formula. But usually, what you'll see is your required rate of return is like from 6% to like 14%. So less risky stocks, probably 6%. More risky stocks, you're going to require a higher rate of return. And we do this so we could come up with a theoretical price. So think of it like this. If I wanted to value a real estate transaction, commercial transaction, and I wanted to give, what do I think the value of this building is? So I could say, well, my required rate of return is 10%, meaning that whatever rent is left over to me I should be yielding 10% on my invested capital, right? Or the cap rate. So I could work from that and estimate the value based on my required rate of return, that if this unit is renting for $10,000 per year in rent, that means to me, it's worth $100,000. Okay. So that's what I'm willing to pay for it. So if it's for sale for 90,000, that could be a great deal. If it's for sale for 200,000, I might just want to skip it because, for this building, I require 10% rate of return. So this is up to you. We just kind of defaulted all of them to 10%. But if you look at, usually models to help out, they'll do like a weighted average cost of capital, which takes into consideration how much debt, how much equity is in the company. It gives those weightings, and then it calculates the cost of equity versus cost of debt. So you could go look that up. That formula is out there, but for simplicity, we just let you change it yourself. So I'm going to keep this right now at 10%. All right. So whatever we earn, I'm requiring a 10% yield on our invested risk. So then I need to kind of determine, well, what is the dividend going forward, right? I'm going to need two more things. I'm going to need the dividend going forward, and then I'm going to have to assign it some terminal value at the end of the period when I want to stop. So here it's kind of defaulted to 5 years. So you got a 5-year horizon, and at that point, you'll reevaluate or whatever. But let's say you give it a 5-year horizon or 5-year period. And I need to estimate, first of all, what kind of dividends I'm going to get. And then what do I think it will be worth at the end of 5 years? All right. So I do need to make those assumptions. So first, let's start with the dividends, right? And obviously, this is a projection. This is going to be a projection based on, certain assumptions. So here, I'm going to come down here to the historical data, and we see here, this is the dividend paid in 2018. This is the dividend paid in 2019, 2020, 2021, and this is year to date. So it might have another dividend in there, all right? So this is so far year to date. And we could see that it's been increasing its dividend. So there's dividend growth, right? And even if we did this year's year to date versus same period last year, we see it's grown by a lot. So we do see that they've been able to increase their dividend in the most recent history, most recent 5 years. And that would be kind of like you would estimate your rent. If you're renting it out, is the rent going to stay the same? Or if it increases, year over year or year over year, then you would want to do that projection. In the next 5 years, what do I think the rent will increase by? So here we kind of defaulted to, it's defaulted to a rate, but it's up to you to change it, right? So it's just defaulted based on historical data. It looks at the historical data, takes the median, gives more weight to the more recent year, and gives it a constant growth rate. So here, because you see it's been growing at pretty, this is a pretty good growth rate actually. But based on that, it's saying, okay, let's estimate that every year they're going to increase it by 30%, right? So 30%, that's a constant growth rate. And you can change that to, maybe a more reasonable, maybe 30% is high. That seems high to me. So let's give it a 15% growth rate. So I'm going to change that calculator. I'm going to give it a 15% growth rate. Okay. And I'm going to just recalculate it. So I'm getting an implied value, but bear with me. I'm going to come back to this. So that seems high to me. Let's give it maybe a little bit more reasonable growth rate. So based on that and our projection where we're going to end up 2022, now we're projecting in year 2023, our dividend, 2024, 2025, 26, and the last year, 2027. So you could also give it a variable rate if you want, if you think it's not going to just grow constantly like this and you wanted to change that, you can go and give it a variable rate. So this would it look like? What do you want to give it a year one, year two? So maybe it'll grow 15%, the first 2 years, maybe then it falls down to 10%. Maybe here it falls down to 7%, 5%. So maybe just starts to decline, as we go out further in time. So you could do that, recalculate, and then it'll give you a different estimate of each year's dividend, right? Based on, wait, did I put 1% here? I'll just leave it there for now. So as we're building this model, and what do we think we should pay for it? It's an estimate, estimates and guesses are important because we don't know the future. So we have to kind of make assumptions, and based on our assumptions, then we could come up with a value. All right. Just like if you bought a property, well, it's hard to say if the rents are going to go up or down and by how much. You'd have to make that estimate, right? And it's even harder for stock and a dividend, but that's part of the model. So you do need to make estimates here. And let's just leave that here for now if there are no questions. The period of years you could also change. So I'm going to keep it at 5 years. Starting dividend, we put it at $10 just based on, I think we take the most recent dividend in any type of guidance, and then we say, okay, let's assume it's $10 at this point, and they're going to raise it from here on out. So they must have raised it to here. We'll take a look at. I'll come back to it, but let's just see here. So this is the most recent dividends. So we could see here that they raised it to $2.50, right? So they just raised it. So now we're assuming that the new dividend is $2.50 per quarter. So that's kind of auto-filled in the model. So let me come back to it. So first, we created, remember, our required rate of return, and we're estimating the dividends. So at the end of 5 years, we need to give it a terminal value because the stock is not going to be worth zero unless it goes out of business. And if we think it's going to go out of business, we shouldn't be buying it in the first place. So we need to figure out, well, what do we think approximately the stock will be worth at the end of 5 years. And it's very difficult to do, but this is a bank, and the banks tend to trade close to their book value. Okay, so usually, they have, it's more consistently some kind of, maybe it's a little bit of a premium or discount, but usually they stay around that book value. So let's take a look at its book value at Goldman Sachs. We could see, so this is terminal value, and we could take a look at its book value per share in 2018, 2019, 2020. So you could see here that it's been growing, right? It's been growing. It's got ups, downs, and here we do put a projection kind of using that historical data. So it uses the historical data to make a projection that you could change. So put in 8.7%. That's where, based on our, methodology, it thinks that, okay, 8.7% a year would be our forecasted estimate. And then you could change that up here. So you could put in your own. Book value, it's using the most recent, I believe, based on the most recent filing. So then we also need to project, what do we think the price will be relative to the book value. Again, we take a look and we see that here is how the price to book valuation ratio in the past has behaved. So you see, it's been at a discount. It's traded right at book value, a little bit above book value, and right now it's trading like 1.1 times its book value, 10% higher. So based on that, we'll say, okay, if we think that the book value will grow by this much, 8.7% a year, so we think the book value will grow by this much, this will be at the end period. And if this is the book value and we give it a price to book value of 1.1, then this would be the value of the stock at end of period 2027. All right. And so we have two things now going on. We have the dividend payments, what we think we're going to get for holding the stock, and what we think the stock value will be at the end of 5 years. And usually, dividend paying stocks that are more mature will trade, around a book valuation somewhere where, this is where it works the best, right? Where something's trading around book value. Once those things start moving around, this would be a less reliable methodology. It's a simple calculator. Remember, this is very simple, just to play around and get different scenarios out. So let's just wait. I changed this from 30 to 15, right? Let's put the growth rate, dividend growth rate, back to 15%. Okay, and everything else I'm going to leave the same for now. So I'm going to recalculate it, and it spits out a value. Implied value $382.61. Right now, the market price is $352.21. So based on my assumptions, this would be a good deal, right? I require 10% return, and if the dividend if they're successful at growing the dividend at 15% year over year, and the book value grows at 8.7%, and the price to book value will be around there, then this seems like a pretty good deal. Now let's come down and see how that works. So we know here, based on our projection, this would be the dividend, for year 2023. This would be the dividend for 2024, this one for 2025, and so on. But we know that money today is worth more than money in the future. So what is this $20 worth to me today? Right. So that's where your required rate of return comes in, right? 10%. So based on that, this is the present value of those dividends. Okay, so that's the present value of the forecasted projected dividends based on my 10% required rate of return. So if I change this, right, the present value will go up, right, because I require less of a return. So let's just change that to, let's say, Goldman Sachs, I require 6% rate of return. I'm going to change it. So see, I'm willing to pay even more for the stock because these dividends are worth more to me than at a higher rate of return. Okay, let's go back to the 10%. And so what are all these dividends worth to me today? Well, I have to sum them up because I took the present value of each one. And then I got to sum them up. So I would be willing to pay $57.25 to receive today, to receive all these dividends, in the future by 2027. Okay. So that's what that theoretically is what I'll be willing to pay today. So what about for the terminal value, right? Well, if I think that based on my assumptions, that the book value will grow by 8.7%. And so then I think in year 2027, this will be the book value, right? And if I think that the stock price will trade 1.1 times its book value, then I think in the future, the stock will be around $524, right? That's the projection based on there. So remember, here you're not summing up. Here you're just looking at end value of the company, right? So you don't receive these like you do the dividends. This is just the end value. So you take this times the book value. So here we're estimating that in 2027, the stock could, based on our implied parameters, is worth $524. So how much would I pay today to wait 5 years to receive $524? Well, based on my 10% required rate of return per year, I would be willing to pay $325.36 today to receive this in the future. So what would the total be that I'm willing to pay? So if I add this up, this is what I'm paying to receive these dividends. This is what I'm paying to sell it at this price in 2027. So if I sum them up, I come up with $382.61. And this helps because you could change the parameters around, play around with it. Well, what if the book value doesn't grow? What if there's zero growth rate, right? It's not able to. And what if instead of trading at a 10% premium to its book value, it trades at its book value, 1 times the book value? And what if the dividends, grow at 5% per year? And I still, and I'm going to leave this, and I still require 10% rate of return. So if I lower all these parameters and recalculate, then I get, a different implied value, right? So that's a quick way using a calculator to test different assumptions to come up with a value to compare to the market price. Just like you would say, okay, here's a building, quick way, what is it worth to me if I require 10% return and the rent is $10,000? To me, it's worth $100,000, let's say. Okay, so that's just really quickly wanted to show you because we just added this feature. And remember, you can't use this for many stocks because, for example, growth stocks, biotech stocks, they're different, right? You would price them differently. But if you're looking at potentially like a bank stock or insurance company that's kind of, maybe even like a utility, let's see, maybe like something like Verizon, that pays, it pays a high dividend. So you do buy this for its dividend. It does trade 2.2 times its book value. So I'm not sure, if that seems high, but let's say price to book. Actually, I'm at 130, Will, so I think I'll just stop there, but I'll maybe do another example tomorrow.
Perfect. And if anyone has any questions, we are going to be on for the pre-market show tomorrow. Awesome job, D. Everyone who joined, Mike, Robert.
Thanks, guys.
It's really appreciated. It was nice to see Brenda back. She's been away for a while. So thanks for everyone who came on this afternoon. Great job, D. Remember, thumbs up, always appreciated. You have a great afternoon, D.
Thanks everyone for joining. Stay safe out there. Have a great trading day, and we hope to see you guys tomorrow.
The safe end of the trading day, chameleons.